Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's 7 a.m. Mountain Time on Monday morning, October 6th. We did not get the monthly employment situation report on Friday, as you all know, but we managed to write a pretty dense note with lots of micro to macro analysis in it, with a particular eye towards the impact of public policy, trade policy on capital spending and the economic outlook, profit margins, and some metrics around how to think about the Gen AI boom. And I know you're all thinking about issues like vendor financing that really resonate with what happened in late 1999, and how to think about those risks and when we reach what seemingly is an inevitable boom and bust point in the cycle. So our note was titled, though, should have been 50. Obviously, we're referring to last month's Fed meeting and our suggesting they should have cut rates 50 basis points. And what we did get from the labor market last week shows that the labor market is decidedly weak. So this morning we're beginning with S&P's a bit higher, and the Treasury curve bear steepening this morning. That probably has a lot less to do with what's going on in the U.S. than the election results in Japan, and we'll have more to say on that. We know that the candidate who won, the perception was she'd be quite expansive in terms of fiscal policy, though we're not sure if this is more to do with tax cuts than increased spending. She fancies herself a Japanese version of Margaret Thatcher, so that wouldn't really imply she's just going to build bridges to nowhere, as Japan is sort of famous for. But nonetheless, we had a very sharp rally in the Nikkei, a very big sell-off in 30 and 40-year JGBs. That, combined with the French Prime Minister resigning, has put pressure on global bond yields, and so that's really what's going on in the bond market. We had a big bank merger. That's consistent with our bank overweight, and these were large regionals, but nonetheless is interesting. We do think that that's part of the whole bank story. It's increased profitability because of a steepening yield curve for most of the spread-sensitive regional banks. It's increased M&A, and it's regulatory policy that we think is going to continue to loosen for the next 3 years. We get the quarterly refunding this week, 3s, 10s, and 30s. And then earnings season will begin a week from tomorrow. So moving on to the notes specifically, we began with a discussion of the crazy low implied correlation in the markets and the role of policy within that, and how policy created super high correlation in the aftermath of the global financial crisis, and how policy is now creating crazy low correlation in the current environment. Moved on to talk about the labor market a little bit, and the Fed's what we called gaslighting guidance, curious characterization of the labor market as being solid or something close to solid. We then moved on to talk about the differences between the Big Beautiful Bill Act, Tax Cuts and Jobs Act, on corporate behavior, buybacks, capex, tariffs, and then discuss tariffs and margin pressure financing the boom, and then wrapped it up with a fixed income supply shock and our final thoughts on the market. So the point around correlation, in short, is that in the aftermath of the global financial crisis, the Fed was providing support for virtually every fixed income asset class there was. There was money market support programs. There was the TALF program to support asset-backed securities. There were purchases of mortgages, treasuries. We had a big fiscal stimulus program, which at the time looked excessive. And all of those things contributed to, with the policy rate pinned at zero, very high correlation when they launched QE2 in the fall of 2010, when they restarted the reinvestment of mortgages and the Operation Twist, which extended the duration of the Fed's portfolio in 2011. All those things created super high correlation of the markets. We compare and contrast that to what happened from 2022 on when the Fed began their unbalanced policy that really broke correlation down between small caps and large caps. Also, the modern supply side theory, industrial policy of the Biden administration picked renewables as winners, picked semis as winners, and was really specific. They eliminated broad-based tax incentives like the immediate expensing of equipment, and that created low correlation where you had this very specific boom in one sector and very, very weak fundamentals in a whole other range of sectors. And so that was our sort of backdrop for the low correlation. But this super low correlation remains a risk. In a risk-off situation, correlation is going to spike, and we could have a very sharp sell-off. Sort of the point of all of this. The markets are somewhat vulnerable to a shock. We sort of wrap that first part of the note up with something that we think is obvious, but doesn't seem obvious to Fed officials. Just looking at the Treasury curve year to date and thinking about the whole policy mosaic and what it really means for the outlook. 2-year Treasury yields are down 68 basis points year to date. The break-even inflation component of the 2-year yield is virtually unchanged. The same thing is true in the 10-year part of the curve. 10s are down, at least through Friday, we're down 46 basis points year to date with the break-even component unchanged. 5-year forward inflation break-evens are virtually unchanged. That is really all the Fed needs to know about the entire policy mosaic. It is weakening growth, and it is not generating inflation. That was the clear signal back in April. The Fed doesn't seem to get this. This is why they should have gone 50. So moving on to the labor market, we call that section gaslighting guidance. The Fed has this curious approach to the labor market as if they really think that somehow if they say negative things about the labor market, layoffs will start, that their guidance and so-called credibility impacts business confidence in the ability to hire, may have some tangential impact on guidance, but they should tell it like it is with respect to the labor market. And there's a whole bunch of Fed speakers, and we're going to get a lot of them this week, that just seem clueless about what's going on underneath the surface in the labor market, despite the massive first estimate of the annual benchmark revision, despite the ADP numbers and the fact that we've had negative small business employment growth in 4 of the last 5 months. We're just really struck by how seemingly off base the Fed is around all this. So moving on to the differences between the One Big Beautiful Bill Act and the Tax Cuts and Jobs Act, we get the latest data from Bloomberg through September, and buybacks are lagging capital spending. This was not the case in the aftermath of the Tax Cuts and Jobs Act, but in both cases, trade policy did dampen the outlook there. And we got all the regional Fed surveys, and we went through that in depth in this week's note. Capital spending plans have been coming down since the Big Beautiful Bill Act was passed, and that's because largely because of trade policy and weaker government spending impacting orders, which are weak. Employment is weak. And of course, the ISM surveys, manufacturing, ISM services were both much weaker than expected with weaker employment. They don't give capital spending plans, and you have to be very careful with those two surveys. They provide a survey on prices paid, but not prices received. We went on to talk about how prices received from the regional Fed surveys have all been falling since the tariffs were implemented back in April. And so that is really a key measure and is consistent with our view that the trade policy and the whole policy mosaic, weaker government spending, trade, tax policy, right, for now at least, is weakening growth and is not creating upward pressure, any meaningful upward pressure on inflation. They could say, yeah, prices paid are up, but if prices received are going down, that means they have no pricing power. That's the bottom line there. We then moved on to talk about, this is a little micro to macro stuff. We showed expectations for profit margins going into this quarter's earnings. They've been negative for staples for at least a quarter. They now look negative for consumer discretionary. You go through the earnings estimates. Both those sectors are expected to have earnings contracting with revenues decelerating. So there's the growth impact, but their inability to pass it through means they're going to take margin hits. And then we talked about the earnings estimates for equal weighted S&P, which are going down or decelerating relative to, and certainly relative to cap weighted, which is a little bit of an unusual circumstance. Typically, equal weighted earnings would be growing faster than cap weighted earnings. That's sort of a size bias thing. That's not happening today, and that can be traced back to the unbalanced policy, but also small companies having less of an ability to deal with higher tariffs and probably getting hit by government spending a little bit harder as well. So moving on then to financing the boom, we went back and discussed this capex to EBITDA or capex to cash flow measures. Gave some more historical perspective on that. Please have a look at the note for all that. I won't go through the numbers here. One big important thing, though, to keep in mind in all these discussions are we in 96, 98, 99, so on and so forth, is in 99, we had gone through one of the, and it was in fact on a real capex weighted basis, the strongest capex cycle we've had since World War II. We are currently not in that sort of environment. The 2010s was the second weakest capex cycle we've had since World War II. So although we have this Gen AI boom, we have all this vendor financing that people are pointing to, comparing Lucent and Nortel to, NVIDIA currently, the broad macroeconomic backdrop is not one where the entire nation has been over-investing in capital spending. We've had very weak capex actually for more than a decade and a half now. So that's a little bit different backdrop that we think is not being widely discussed. The note then starts to move into this fixed income supply argument that we introduced recently after our trip to New York. We have a chart in there on IG credit issuance. We're going to be watching that closely to see if that starts to pick up, particularly in the first quarter next year. If we're right, we get the rate cuts we expect. We would look for mortgage-backed security, new purchase issuance to start to pick up, net supply of mortgages to increase. There's a couple of big questions to be answered with respect to Treasury issuance picking up. Do revenues start to fall when refunds pick up early next year? No taxes on tips, all the individual provisions of the big, beautiful Bill Act. Does that create need for more government financing? What does the Fed do with their portfolio in the NQT? Lots of reasons why we may get a pickup in fixed income supply early next year, which could create another rate shock similar to what happened in early 2018. So it's too early to position for that, but we're watching it, and we just try to provide some more granularity around it in this week's note. Final thoughts, we think 10s will be in a range, trading a range between 4 and 4.25 for now. Going into earnings season, we definitely stick to our themes, but we would be cognizant of staples and consumer discretionary rallying on poor results with the idea that this is as bad as it's going to get and things will get better from here. We tend to fade that. We would also, fade the other side where investment-related results, tech results, this is as good as it gets, and then the stocks sell off, and probably would fade that too because we don't think that these themes are by any means close to being complete. We think the reaction to large cap financials will probably be pretty okay. Small cap financials, the results may be a little bit more disappointing, but we still like the sector, and I think we're going to get that big bump in ROE as we get into early 2026. So that's it for me. This was long. I apologize, but there's lots of stuff in the notes, so we were probably saving up for all the stuff that we didn't get a chance to get at the previous week when we were traveling. So Barry Knapp from Ironsides. Have a good week, everyone. Thank you.